be $40,000. Book value has nothing to do with market value or resale value. Next type of adjusting entry we would have is an accrued expense. It's an expense that's incurred before the payment is made. It results in a liability. Okay? If you want to think about what an accrued expense is, it's the opposite of prepaid expense. So if we have salary expense at the end of the period, but our employees are on a bi-weekly period and they're not getting their check till next week, what we would do here is we would debit the salaries and credit salaries payable. That's how it results in a liability. Debit the expense, salaries, credit the salaries payable. We've created a liability. Why? Because we've incurred the expense, but we haven't yet paid it. Interest would be another great example. Interest expense on a loan that we're not going to pay the interest until the loan becomes due. So we record the interest expense in the proper period, and we set up a liability of interest payable. So how do we record these accrued expenses? Interest expense we debit, interest payable we credit. For salaries that have been incurred but not yet paid, we debit the salary expense and we credit the salaries payable. Accrued revenue, that's like our Chapter 2 law firm example. Revenue is earned before the cash is received. Debit the accounts receivable, credit the service revenue. Okay, to record accrued revenues. Service has been performed. The only thing that's left to be done is to collect the monies. Debit the accounts receivable, credit the service revenue. Unearned revenue is cash collected before the revenue is earned. Okay, let's stop right there. Let's give you a good example. If you purchase season tickets for a sporting team, say the Orioles or the Ravens, the teams collect the cash in advance before the games are played. So every time a Ravens game or an Orioles game is played, the revenue for that game would be recognized. So what the company does is when they receive the cash, they debit the cash and they credit unearned ticket revenue. It's a liability because the company owes the service to the ticket holder. Or they would have to return the money. Say if the game was canceled or it was called off or it wouldn't be rescheduled. That money would have to go back to the ticket purchaser. This is also known as deferred revenue. Another example would be if I was paying you to restore a classic car. Okay, well, if it's going to cost $50,000 to restore my classic car, you want to have some of the money up front. This is a good faith deposit on my part. So what you would do is you would debit your cash account and credit unearned restoration revenue. So that's an example of an unearned revenue. Okay, so the cash comes in, we credit the unearned revenue, which is a liability account. Don't let the word revenue in there fool you. An unearned revenue is a liability account. Okay, when the part of the service has been performed, the adjusting entry down here would be debit the unearned service revenue, that's going down, and credit the service revenue to recognize a portion of the service revenue that was earned. Another good example for unearned revenue would be magazine subscriptions. You pay for a year's worth of magazine subscriptions, but the revenue by the magazine isn't recognized until the magazines are subsequently mailed to the customers. So if you pay for a year's worth of Sports Illustrated, each month Sports Illustrated would recognize the revenue from the unearned magazine subscription revenue account. So, to summarize adjusting entries, the need for adjusting entries is to properly measure net income on the income statement. Remember, all the journal entries we just talked about dealt with either a revenue or an expense. Okay? And also, what we're doing is we're updating the balance sheet. All of the entries we just went through were affecting either an asset or a liability account. So we're trying to properly measure net income, and we're trying to properly reflect the balances on the balance sheet. Okay? So, here's a nice little slide which represents a summary of adjusting entries. Here are your 5 categories: prepaids, depreciation, accrued expense, accrued revenue, and unearned revenue. And here is a list of the debits as well as the credits for each transaction. Prepaid, you debit the expense, you credit the asset. Depreciation, you debit depreciation, you credit the contra asset. Accrued expenses, you debit the expense, you credit a liability. Salaries payable, interest payable. Accrued revenue, you debit the accounts receivable, you credit the service revenue. Unearned revenue, ticket sales, magazine subscriptions, you debit the liability and credit the service revenue.